Hey there, everybody, and welcome to Yahoo Finance Live. Happy Monday. It is February 6th. I'm Dave Briggs, along with Jared Blickery. Let's get up to speed now on what we have coming up for you this afternoon. The United States military has shot down a suspected Chinese spy balloon that was flying over the Carolinas. Concerns over tension between the two countries is sending U.S.-listed Chinese companies lower. We'll dig into the implications.
Plus, it was an ugly week for big tech last week, but we got more reports coming at your way tomorrow and today after the bell. We're going to bring you results live from Pinterest, Take-Two, and Activision Blizzard later in the show.
And after 34 years, two major beer brands are joining forces for one pricey 30-second spot in the Super Bowl. We'll sit down with two executives from Coors Light and Miller Lite and ask them why 30 seconds could be worth $7 million.
But first, let's begin today with our top story. The U.S. striking what it's calling a spy balloon out of the sky just off the coast of South Carolina on Saturday. The explosion already sending geopolitical shockwaves, with Secretary of State Anthony Blinken calling off a visit to China following the incident. China maintains the balloon's appearance in the U.S. skies over the last week was an accident and claims the U.S. used indiscriminate force by shooting down the balloon. Yahoo Finance's Rick Newman is here with his top takeaways. Rick, can you clear the air for us, no pun intended?
No, I cannot. Everybody thinks they know what happened here, and nobody really knows what happened yet. I mean, this balloon is now on the ocean floor. The Pentagon is sending divers and ships down to retrieve all the wreckage, and it will eventually know a lot more about this balloon. What was on the balloon? Was it camera sensors? Was it other types of sensors? What were they looking for? What was its purpose? Who was it communicating with in China? Who owned it? What part of the Chinese government was responsible for this? I mean, we have tons of unanswered questions here. The Pentagon is not going to tell us everything they learned, because some of this will be intelligence secrets. They need to tell us more, though, because this balloon made such a public visit to the United States. And of course, we've now all seen the footage you guys were just showing of the balloon falling into the ocean after an Air Force plane shot it down. Lots of theories here. A lot of people are saying Biden should have done this, Biden should have done that. I'll tell you what, a lot of people don't know what they're talking about. We have too many balloon experts in the United States right now.
My personal favorite was Saturday Night Live. I mean, what an interesting scenario in which a Chinese spy balloon becomes the SNL cold open, Rick. But now the balloon is a political football. Does either party really have much of a leg to stand on given the past?
I mean, it depends what we find out. So the Republican criticism of Biden, obviously, anybody who heard anything about the Sunday morning news shows knows this, is that he waited too long before shooting the balloon down. And I'm not sure that's right at all. I mean, it's obvious that Biden should not have ordered a shoot down of this thing over land. I mean, if you can wait, look, they modeled where this balloon was going just based on winds. So the Pentagon knew it was going to end up over the Atlantic Ocean. And yet you had, people saying, oh, the balloon's over Montana. I don't want it over my state. Shoot it down. Well, if Biden had ordered a shoot down over Montana and, a single head of cattle or a single chicken was injured, the same people criticizing Biden for waiting too long would say that he didn't wait long enough. The people just need to calm down and figure out what are we going to know once the full story is in about this balloon. It's quite possible that Biden did the right thing by letting this balloon traverse the country. Everybody seems to not think, well, let's put it this way. People think that, the Pentagon was just sort of sitting there staring dumbly into the sky and doing nothing. They were not doing that at all. They were pointing all the intelligence gathering tools the United States has at this balloon, figuring out what they can tell about it. They were probably flying all kinds of aircraft around it, taking their own technical sensor inputs and things like that. So this could have been an intelligence bonanza for the United States. I mean, I realize it's only a balloon, but this could have ended up better for the United States than a lot of people think.
I'll tell you what, Rick, Governor John Dutton of Yellowstone fame, he'd have taken that thing out right away.
He would have flown up there in his own plane and taken it out.
I mean,
which I think is what Ted Cruz and a lot of other Republicans say they would have done. But of course, would have been different if they were running the show.
Yeah, reports are there were 3 in the Trump administration that we never heard about. Rick Newman, good stuff. Thank you, sir. All right, the takedown of the Chinese spy balloon is raising investors' concerns about a fresh round of geopolitical tensions. For more on the impact of and the downfall of the Chinese spy balloon, Shahzad Kazi is here, China Beige Book International Managing Director. This is just fascinating. You've got several members of Congress backdrop to this, trying to ban TikTok. You've got Kevin McCarthy planning a visit to Taiwan. You've got the Secretary of State planning to visit China. And in the midst of all this, they're spying on us with the balloon. How does it impact, how does it deflate, if you will, yes, pun intended, U.S.-China relations?
Yeah, the timing on this could not be worse, I think. The obvious, of course, is what you just mentioned, especially with the Secretary of State's visit coming up. But I think from the Chinese perspective, the timing couldn't be worse because, look, they have just reopened the economy. They are out of the Spring Festival holiday period. They're supposedly over their COVID peak. This is an economy that is getting ready by what you hear out of Beijing to roar back to life. And this is where they want investor confidence to go up, not to be hurt. This is not a time where they needed geopolitical tensions, but by mistake or by design, they have undone some of that, at least over the last 24-hour period, from what we can tell. So from the standpoint of wanting to encourage investors to take a positive look at China, well, not kicking off 2023 on the best note for now.
And Shahzad, when we think about Taiwan, potential headwind, not necessarily in the near future, but heading down the road here, I'm just wondering, does this stoke, well, I know it's stoking conspiracy theorists in the U.S. and also investors who are concerned about the potential implications of an invasion of, well, I guess a more forceful takeover of the Taiwan economy. What are the odds of this?
Look, it depends how far out you want to look, right? So is it happening by the end of this year? No, but in the next 4.5, 5 years, can we be looking at a 50-50, maybe 60% chance of a Taiwanese invasion by China? Quite probable, yes. So it depends on that. Now, we know for a fact that the Speaker of the House wants to take a trip to Taiwan. And I think what we're going to get when that happens is probably a far more aggressive Chinese posture than the one we got when a former Speaker, Nancy Pelosi, made her visit.
He has no choice now but to show strength, McCarthy, and continue with that visit. So I'm looking at K-Web here, down about 2.5%. What's the impact on Chinese U.S.-listed companies?
Yeah, it's negative. I mean, last night you got a sell-off in the Asian equity markets. There's already been concern. Now, keep in mind, this adds on to concerns that perhaps we don't get a consumption rebound in China as swiftly and that is as big as the initial positioning suggested back in December. So as it is, investors are starting to get concerned about how soon do we get this Chinese recovery to take place. This is, of course, just making things a little bit worse as you know, at the moment.
So are we just simply kicking the can down the road? I want to get back to the Chinese stocks because that's what investors may be caring about here. And you talked before about this happening at an inopportune time. We've seen the rise of Chinese stocks tend to be correlated with margin debt, meaning that the retail investor in China, very important. What does this do for Chinese stocks?
Well, look, I mean, let's see what they look like through the rest of this week. But I think this is starting to dampen investor confidence for sure. And look, mainland investors are pulling out too. That was a big story overnight, right? They're getting concerned. There's sell-off coming from that side as well.
And you've got companies beginning to shift their production away from China well ahead of all this, like namely Apple. What about a congressional response, whether it be Republican or the Democratic Party?
Yeah, a couple of things here. First of all, I think this really strengthens the hands of people like Mike Gallagher, and the idea that you need a select committee on competition with the Chinese Communist Party. I can't think of a better reason than this, politically speaking. I think this may force some of the Democrats, especially those Democrats who have some very valid concerns about how this could go wrong. They may have to take a second look at it and become a little bit more serious in having a conversation in D.C.
Do you think it only speeds up the TikTok ban calls in both parties, quite frankly?
It absolutely will go a long way in accelerating the timeline on becoming serious about Chinese investment in the United States, China's access to U.S. technology inputs and so forth.
Let me go back to the stock market yet again, because it was a couple years ago, shot off the bow, DD IPO launches in the U.S. and the Chinese regulators, they don't treat that situation very well. I'm just wondering, do you think there's lingering hostility towards the sharing of U.S. listings with Chinese companies? And do you think that's something that's going to see more controversy and more conflagration in the future?
We may get some more controversy and conflagration, but one thing we're certainly getting is the larger concept of financial decoupling. I think there has been a decision made in Beijing that if certain Chinese companies cannot list in New York or cannot stay listed in New York, well, then so be it. They're going to come home. They're going to go to Hong Kong. They're going to go to Shanghai. That's the landscape I think investors need to become smart on and prepare for.
All right, really great stuff there. We've got to leave it there. Shahzad Kazi, thank you. All right, now we need to turn our attention to U.S. markets right now. I'm going to check the markets on the Wi-Fi Interactive. I'm going to take a look at, well, let's take a look at the 10-year just first. That is up 10 basis points, pretty big move right there. Also taking a look at the 30-year, that's up 4 basis points. And now we can get to the stocks, and let's see, the Dow is up 13 basis points, S&P 500 up about 62 basis points, the Nasdaq almost at 1% also. Oh, these are all down moves, I should say, and the Russell down about 1.5%. And then you take a look inside the sector action, who's taking it on the chin the most is communication services, tech, and materials. All three of those are down more than 1%. Utilities and staples up just marginally. And now we want to bring in Gabriela Santos, JP Morgan Asset Management Global Market Strategist. As I promised you before the show, no questions on balloons, but I do have to ask you about the U.S. stock market. And just to kind of set things up, Wednesday last week, we had this big Fed meeting. We saw stocks rocket to multi-month highs here. People are excited. New highs the next day. Then we get that payrolls report a little bit heavier, a little bit hotter than expected in terms of the number, down for that day in the S&P 500. And now people are saying maybe that was an interim top. Does the Fed know what it's doing? What's the outlook here?
I think the trick is we came a little fast and furious out of the gate this year in terms of equities, in terms of bonds and credit. And there has been progress, right? We are seeing disinflation. We are close to the last rate hike. We have priced in some better soggy growth into earnings expectations. They're down 7 percentage points since May. So investors are reducing underweights and getting a little bit more involved in adding risk, especially on the equity side. With that said, it is not surprising that there is some consolidation here and perhaps even a period of some further downside in risk and in the bond market. Because fundamentally, we still have unanswered questions. Where does inflation settle? Are there going to be rate cuts? And can the economy and earnings get through this period without a period of contraction? So we don't want to go to the other extreme and go overweight equities quite yet. We think a small, very small underweight makes sense. We don't want to be chasing everything here so far so soon.
Yeah, given the earnings that we've seen thus far, it is surprising. The Nasdaq's been up all 5 weeks this year and the S&P 4 out of 5 weeks this year. Can that type of momentum continue?
So it does seem to us that we are perhaps starting, or perhaps soon will start, a period of some consolidation and even a sell-off in the equity market again, going back to that earnings question. Now, we have made some progress. Back in May, we were expecting 9.7% of earnings growth for this year. We're now expecting consensus 2.5%. So there's been progress, but that is still too high for a soggy economy with wages rising, higher interest rates, and higher corporate taxes. So we just think, given that scenario, which is still kind of a soft landing scenario, earnings need to price in a small contraction of -5%. And then if you start pricing in the risk of a mild recession in the second half of the year, then you're talking about an earnings contraction of -10%, -15%. So it goes back to that earnings question, the margin pressure, the decline in demand, and the need to still price that into the equity market and the credit market.
Yes, and we haven't seen the credit market fall out. I've seen spreads pretty tight recently. So let me ask you if I'm getting this right. You're not expecting the bottom to fall out. We're probably going to have a negative quarter of earnings growth in the S&P 500 this quarter. Maybe we get one next quarter, so we get that earnings recession. But how deep are we talking about here? And what's the potential headwind? What's the where are we wrong?
Exactly. We don't
Yes.
imagine the bottom to fall out, quote unquote, or an earnings contraction like you've had in the previous 2 recessions, which then is -20, -40%. We're not talking about that kind of scenario. And we've also adjusted expectations over the past few months a little bit lower, which is good. With that said, we're still to be seen a period where we need to better price in that contraction I mentioned of -5% for just a soggy economy or -10 to 15% for a mild recession. So we're not quite there yet. So where we shake out is we're past the period of being very underweight equities versus bonds, but we're not quite at the other extreme of being overweighted. We want to be close to that neutral with a very small underweight. And especially when it comes to credit, we want to still be leaning into investment grade over high yield because spreads are extremely tight in high yield, 400 basis points, and we think there'll be a better entry point later in the year when they get above 700 bips.
Many a guest sat in that seat and killed the 60-40 portfolio time and time and time again. You say it's back. Why?
We do absolutely say it's back because this is the year where we're talking about disinflation, not inflation. And inflation was what was so damaging to both sides of that 60 and the 40 last year. And now we're really talking about a period of bringing inflation back down to earth. So bonds can react as a diversifier. They're reacting much more to recession fears. So you've got that diversification benefit. And for both sides, you now have a better entry point in terms of valuation for the long run. So we're the most optimistic, not short term, but long run returns that we've been since 2010. And it's not just in the US, it's also in international. We would take that other side of the China discussion. China, emerging markets in Europe is where we would already be overweight on the equity side versus the US.
We'll take optimism in whatever form it comes. Gabriella, nice to see you. Thanks
Nice
so
to
much.
see you.
Appreciate that. All right, we're just getting started here on Yahoo Finance Live. Coming up, the road ahead for Tesla. The EV maker confirming it will finally build the long-awaited Cybertruck by the end of this year. Will it really happen? Then earnings season rolls on with Pinterest, Activision Blizzard, and Take-Two Interactive reporting after the bell. We'll deep dive into the company's latest financial results. And thousands of unionized workers at Disney World are looking for a bigger payout after rejecting a proposal that would have given workers at least $1 an hour raise. All that in the next 2 hours. Stay with us.
Elon Musk first unveiled Tesla's Cybertruck, windows smashing and all, more than 3 years ago. And the EV maker says it will finally start building the vehicle by the end of this year, 2023. Senior auto reporter Praz Supermanian is here with the details. Praz.
Yeah, you know, Jared, we saw last earnings release with Tesla talking about, Elon talking about how we're going to see this truck go into production mid-2024, 2023 this year. Volume production beginning of next year, and he said that it would add considerably to the bottom line, right? So this is a big release for them, supposedly on track after a 3-year delay, right? But I think there's some other question marks here with this truck. You know, big nice piece to the New York Times about how the stainless steel construction that they want to use for this truck is actually not that conducive for kind of mass production because it's hard to work with that material. It's difficult to weld. It's heavier. It can't be stamped or molded like regular steel parts. Also bad for safety, right? Because it can't easily crumple like most other types of metal. So kind of a problem here. You know, and what was the last car that was a stainless steel? The DeLorean. Exactly. We all know where that went. But I think the bigger point is, aside from production issues, things like that. The design is so polarizing. Are people going to actually buy this truck versus the Rivian, versus the Lightning, versus the Silverado that's going to come out soon? So I think that, for me, is the big question. Is this thing going to be a mass market car when it just looks so out there?
It is the perfect embodiment of Elon Musk. Polarizing, sharp edges. We shall see. All right, shares of Canoo sinking today on news that the EV startup is trying to raise some cash by selling discounted shares. What's the latest here?
I mean, Canoo has just been in the news for all the wrong reasons, with money problems. A big kind of raise here, up to $100 million, 100 million new shares, very heavily dilutive to current shareholders. You're not happy about that. The company has been struggling to get their one sort of product off the ground, this delivery van you're seeing right here. They have a big deal with Amazon, about almost 5,000 units that they want to sell to them. But the question is, can they have enough money to build these things and then enough runway to continue and survive? I think that's the problem. I think the actual vehicle, I've seen it in the flesh, it actually is pretty interesting. A very cab forward, a lot of space inside that cab there, supposedly autonomous, things like that. But can they get this thing off the ground? How much is it going to cost to make? What are your margins going to be? These are all the big questions that you ask for any EV company, let alone Canoo, which has been kind of struggling for a while now.
Yeah, it looks like they're at least sweetening the deal with those stock warrants, but anytime a company's trying to sell stock and they got to add a sweetener to it, a little bit wary here. Thank you for that, Praz Supermania. Now, coming up, shares of Spotify moving higher after an upgrade from Wells Fargo. We're going to tell you why the analyst is bullish on the other side of the break.
All right, time now for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. RH, Spotify, and Tyson Foods. Ali Canal playing ball with us today. My play is RH, the artist formerly known as Restoration Hardware. Shares plummeting today on news of accounting errors. The home furnishings company announcing that prior to unaudited financial statements for 2022, quote, should no longer be relied upon due to material unintentional errors within quarterly reports. RH also pre-announced full-year growth at the lower end of the prior range of -3.5% to -4.5%. On the flip side, Wedbush's Seth Basham points to a plan to repurchase 1.8 million shares as a signal of confidence from management. As a result, Basham raised his full-year EPS forecast, maintaining a neutral rating while hiking his price target to $335 from $270, guys.
Honestly, I think, accounting issues aside, there's a lot of pros and cons with this company, and we've heard various commentary on the street. You mentioned some of those recent notes. We also heard from analysts at Telsey Advisory Group, and they wrote in a new note that RH is a solid brand with greater potential to accelerate growth in the medium to long term. However, there seems to be less demand for RH products overall and home furnishing, which will obviously drag sales throughout 2023. So definitely some major headwinds there. And then if you think about the competition too, that's obviously a big overhang in the background, and shares, they're still fighting to bounce back from where they were last year, still off about 20%. But speaking of a company that has struggled with their stock price, my triple play is Spotify. Shares are moving marginally higher today, up about 1.1% after an upgrade from Wells Fargo earlier this morning. Analyst Steve Kehall upgrading the stock to overweight from equal weight. He also upped his price target to $180 a share, up from $121. The analyst cited potential margin upside as a catalyst for the upgrade, writing in a new note to clients that the music streamer is off margin probation as its, quote, commitment to margin improvement is picking up pace, I should say. But Spotify's declining gross margins, that's been a big pain point for investors. We did see that number beat expectations in its last earnings report. Shares, though, are still off about 65% from those record highs that we saw in February 2021. So do you think this is a story that can really improve for this company?
I think that with the current interest rate environment, that it is going to be difficult for some of the older streamer players, a lot of these older growth companies, just to catapult themselves to the next level. It's a saturated market. They don't have free money anymore. Not that Spotify necessarily needs it, because they have the free cash flow now that they wouldn't otherwise. But I just see this as a different market environment. So I think it's going to be a little bit tough for them to bounce back.
Really need to cut spending. They continued to cut the layoffs. And when you heard from their CEO in the latest earnings report, it was about cutting back on those massive acquisitions that we saw the last couple of years.
Exactly.
Some discipline.
And now there's no natural segue for this that I can think of, but Tyson.
If you find it, you're my hero, buddy.
ChatGPT, we're going to get ChatGPT on this. Tyson is my pick, testing some of the lowest levels in price since 2020, also having its worst day since, guess what, last quarter. Much like then, its margins are in focus as volatile commodity prices make pricing a challenge. And you can see that is a max chart on your screen going back to the 1980s, quite the top in there. Now, Consumer Edge is noting that the beef segment, in particular, flagging the elevated cattle prices and also the feed for pork. That's getting expensive as well. Analyst does say, quote, its pricing power at retail has been made clear along with efficiency and capacity levers to pull. So maybe more, a little bit more there in coming quarters. Now, Consumer Edge rates the stock overweight with a $90 price target. Stevens, another firm, still likes the stock, keeping it an overweight and saying earnings likely have now troughed, so the bottom perhaps in. But the analyst is reviewing the price target due to a lack of near-term catalyst, saying the stock is still interesting to long-duration investors. I'll just quickly say, Staples, great play last year as we experienced the worst year for 60/40 in probably our generation and many generations, not necessarily so this year, so maybe a different strategy for investors.
Yeah, you mentioned the margins, also concern for them being that their data finds that consumers are spending less on those pricier cuts of meat. And I was really surprised to see the price of beef down 8.5% in the same quarter last year, while chicken's up up 7%. So complete opposite directions. You're what?
I'm bidding up the price of beef. I
you're
am
a big
getting as
beef
much.
eater?
I am, and now we have a Whole Foods
I know.
in the financial district.
Jared and I run into each other at the Whole Foods all the time.
No place else.
It's worth it.
Tyson Buffalo Tenders. That's my tip, guys.
Well,
Underrated, folks.
You know what I thought was interesting is that the prepared foods was the only business segment to show an increase in operating income. And you have to wonder if that's maybe a trend that we'll see throughout this year, consumers gravitating towards those more convenience items amid inflation. We saw that during the pandemic, maybe
Makes
in the
sense.
future. I know, I do. I like the convenience frozen foods.
Cannot
all the
resist
time.
them. Allie, thank you for playing with us today. Coming up, Netflix going to start cracking down on password sharing. Now we're starting to get an idea of how many people they say will leave the service because of that. We'll have the details for you after the break.
Netflix users are up in arms, threatening to cancel subscriptions over the streaming giant's account sharing crackdown. Now, a new survey conducted by Jefferies, they're showing that 62% of password borrowers would stop using its service. But despite the recent password sharing headwinds, our next guest remains bullish on the stock. This is Jason Helfstein, Managing Director and Head of Internet Research at Oppenheimer, who is joining us now. Jason, thank you. Just your big picture thoughts. Does this help Netflix? Do they get away with this in the end? Are they able to make this a success?
Absolutely. So they've been A/B testing this in South America. They would not be doing this if they thought they would end up in a worse revenue situation. The bottom line is there's a massive amount of password sharing, particularly amongst affluent people, let alone a broad part of their range. So we do think a good chunk of their subscribers will probably pay more to keep certain members of their household, or let's say their children who no longer live with them, on their plan, or their mother, for example. But we think this is a net positive. They know what an advertising subscriber is worth. They know what password sharing is worth. And effectively, if you don't if you don't want to pay, you can go to the ad plan. And so I think that's what's going to happen. You're going to add more delineation between the tiers that they offer.
Jason, I think this is going to be a really bumpy ride with subscribers. Do you think it'd be well received? Do you think there's some numbers here that they're not seeing? People that don't share passwords that might in fact drop the service. I'm talking about myself.
But they're not raising the price on you, so why would you drop the service?
Well, when you read these rules and you hear that when you go out of town, you're going to need a code, and when your kid goes somewhere, they're going to need a code, and that type of annoyance, if they don't have extraordinarily sticky content, is going to make you reevaluate your streamers.
So first of all, I think they do have sticky content, and where we're at right now, they're spending more than everybody else in streaming, and they have a profitable business. And given the economic pressure that the media industry is facing, and can make an argument the media CEOs are trying to keep their jobs, getting positive unit economics out of streaming is a priority. So I think we're past the point of competitors flooding the market with unprofitable content, which is what we saw for a good chunk of last year. So we do think as over the next 12 months, you'll see, I think Netflix definitely with a competitive content advantage. And I think you saw it even in the last quarter. There was a comment actually that what has been talked about is not 100% what they're going to do. So I don't think we know the final, the final, for example, will you not be able to keep your college kid on the service, right? It wouldn't surprise me if they come up with a way to make that happen, right? Where okay, every 90 days or something, your college kids has to authenticate in some way, shape, or form. So look, this is a company that historically has prided itself on very customer service above all. I mean, they've arguably been the easiest of all streaming services. They've never required any authentication, never limited the number of devices, let you keep the most simple, easily guessed passwords. And look, the reality is people have taken advantage of it. I mean, sharing your Netflix account with 20 other people is probably not what the company had in mind. I think, if people are reasonable and share this with 5-6 people in their family, I think it's going to work out.
If people are reasonable. All right, I want to get to gaming here because we haven't talked much about that. In fact, I haven't talked about that in weeks. Anything new on that front, and how is it looking in terms of their aspirations into the space?
Yeah, I mean, we didn't really get much of an update. It's not something we're focused on. I mean, they do share a little bit of metrics. I don't think most people are focused on it. It's a very longer term initiative, whether it's taking IP of games, creating content, taking content, making games. It's given what the launch of the ad tier right now, that is the big initiative for the next 2 years. And I think gaming, very, very far on the back burner.
All right, the story of the year, at least to some, ChatGPT. Google has announced they are just about finished with Bard. Their answer to ChatGPT should be rolling out in a few weeks. How far are they behind? What type of threat is ChatGPT to Google's search business?
Yeah, it's too bad they couldn't call Brad. I don't know. We're gonna mispronounce as companies try to come up with these different names.
Right.
But look, we think it's well known that Alphabet, effectively has been the leader in AI with papers published. I think in 2017 is when they published the kind of leading paper on big models called basically leading something called Transformers. No connection to the animated the Transformers franchise, but these models that allow you to effectively use very big data to come up with these outputs. And so they have this data, they're spending a lot of money on it. What they didn't ultimately do is build that front end that allowed you to have that conversational interaction. To use it, you had to effectively be a coder. So look, I think ChatGPT caught Alphabet off guard. I think they're recognizing it, and I think this is going to be the first version of what you see. I actually think this is an acceleration of their plan. I think the prior idea was that when they hosted their I/O day in May, they would announce a product. So I think they're absolutely fast forwarding everything they can around AI to ultimately prove to the market that they don't believe they're behind OpenAI or ChatGPT.
I think the big win here is for consumers. We're going to be surrounded by tech that is just too incomprehensibly great to comprehend. And, well, let's hope it gets used for the right way. Got to leave it right there. Jason Helfstein, thank you very much. Now, before we go to break, let's take a look at Bed Bath & Beyond shares. This is a Wi-Fi Interactive, and I'm going to have to sort this by performance because here we go at the upper left, BBBY up 88%. Now, this stock had been halted at least once that I know. I'm trying to bring it up here, see if we can. There we go. Here's a one-year chart, and here's a two-day chart. Maybe we can see the price increase right there. There we go. From Friday's base reference point, up 72.67%. Also got to notice that AMC, only up 16%, was halted. All of this probably an indication that there might be some juice left in the meme stock trade, but you take a look at these peaks from years prior, not as much juice as had been there before. Now, coming up, it's game on for Molson Coors. We're going to speak to two execs from the Coors and Miller family brands on why Molson Coors finally making its way back into big game day ads after 34 years. After this.
Yeah, forget Chiefs Eagles, Miller Coors, that's the real matchup. For the first time in 30 years, Molson Coors is returning to the big game. The beverage company's high-stakes beer ad during Super Bowl 57 comes after rival AB InBev ends its alcohol advertising exclusivity during the game, which took effect back in the late 80s. Joining us now for what we can expect on Sunday and how fans can cash in are Sophia Colucci, Global VP of Miller Family of Brands, and Marcelo Pascoa, Global VP of Coors Family of Brands. Nice to have you guys together. Nice jacket there, Sophia. Let's start with you. It's not a no-brainer to advertise, even though the exclusivity's gone. It's $7 million for 30 seconds. Why is this opportunity worth it for you?
Well, and thank you for the compliment on the jacket. I think Marcelo's a little jealous that he doesn't have the massive branding that I have right now. But look, the Super Bowl is a massive beer drinking occasion, and we've been waiting for over 30 years for this moment. And we've been pretty public about it. It took us less than a minute to decide to buy an ad once we heard that exclusivity was no longer. And we deliberately designed this in a way that not only excites our fans leading up to the game, but it also has them engaged during those pivotal 30 seconds because they wouldn't have seen the ad before. And we really want to make it count.
Marcelo, why to you is it worth that type of ad expenditure?
Listen, you have to think about the entire program, right? I think that if you're only focused on what you're doing during those 30 seconds, it's probably not really that worth it. But we have a full program that goes way beyond what is happening in the 30 seconds. Actually, the 30 seconds is going to be the climax of something that is going on very strongly right now. So we're asking all of our fans to go on DraftKings and try to predict every single element of the commercial that we're going to be running in the big game. So if you can build a program that is going to engage consumers and help sell a ton of beer, then it's definitely worth it. But it has to be beyond what is happening in those 30 seconds.
Yeah, 2 weeks of buildup is what truly makes this, dare I say it, almost a bargain. Sophia, make your case. Why Miller over Coors?
I mean, it's obvious. First of all, great taste, less filling. We are the original light beer. We are growing share in the total beer category. We have 16 NFL alliances. And look, we've got pretty great swag, as you can see.
I grew up in Colorado on the Coors Light. So I got to ask you, Marcelo, why Coors?
Listen, to me, it's a no-brainer, and I appreciate Sophia's points. But first of all, the Coors Master brand is celebrating in 2023 150 years. It's our 150th anniversary. What better present for a brand that is celebrating 150 years than a spot in the big game? We are the biggest brand in the building. We're an iconic brand that can bring the kind of mountain cold refreshment that people need when they are watching a game like this. So for me, the case is pretty obvious. It has to be Coors Light.
Sophia, curious about the partnership with DraftKings. Why was the moment right for that?
Yeah, absolutely. We've had a partnership with DraftKings now for a number of years. They're wonderful partners. And look, we're seeing now too, the idea of betting, gamification, it is massive right now. It's super popular. And people aren't just betting on sports. They're betting on who will win The Bachelor. So it's just a really big thing in culture right now. And people are talking about this being the betting bowl and the beer bowl. And we are, on trend and leading it on both fronts. So we're really proud about that.
Marcelo, the ongoing theory is that you guys are going to share the spotlight on Super Bowl Sunday. Your reaction?
Well, first of all, if you want to know what's going to happen, you should watch the spot during the game. There are certain elements of this spot that I don't really know. Even myself and Sophia, we don't even know what's actually going to happen. Like our boss, the CMO, Michelle St. Jacques, she holds some of the answers that even Sophia and I don't have. So my recommendation to everyone, if you want to know what happens, tune in during the big game and see who is actually going to take it.
All right, well, you've piqued our curiosity. Thank you both. Sophia Colucci, Marcelo Pascoa will be watching, indeed, with 100 million other Americans. Thank you both. All right, a quick programming note. Be sure to watch our big game coverage on Friday, February 10th from 4 to 5 Eastern Time. We'll dive into everything from sports betting to ad spending and even get into some prop bets. Please don't miss our Super Bowl preview. Plus, coming up, Elon Musk's Twitter takeover. It's been a rocky ride to say the least. We'll discuss why Musk remains hopeful about the social media company's prospects next. The pressure may finally be getting to Elon Musk. The Wall Street Journal reporting Musk has trouble sleeping at night and has severe back pain. These troubles have plagued the Tesla founder for years, but it's reportedly worse now. Musk says his workload has grown since taking over Twitter. He's gone from working as much as 80 hours a week to more than 120, according to the Journal. Musk responding on Twitter to the Journal, admitting he's had a tough time, writing, "Last 3 months were extremely tough as I had to save Twitter from bankruptcy while fulfilling essential Tesla, SpaceX duties. Wouldn't wish that pain on anyone. Twitter still has challenge, but is still trending to break even if we keep at it. Public support, much appreciated." Elon even adding, Twitter is definitely not financially healthy, but is trending to be so. The Information reported recently that Twitter's ad revenue was down 35% in the fourth quarter. To counter that, the company will reportedly charge companies $1,000 a month for brand verifications. Will you pay? Love to hear that. And they've also offered $250,000 in free advertising around the Super Bowl, which appears to have some early returns. The Information also reporting AB InBev and PepsiCo have committed around $3 million in Super Bowl Twitter takeover ads. That gets us to this question. The question, do you think Elon will make Twitter profitable? We put that out on a Twitter poll, and overwhelmingly you say yes. 56% of you say Elon will indeed make Twitter profitable. Jared, I say no. I am in the no camp. He has gutted that place of employees, first off. He has allowed the ugly voices on Twitter to get louder and to get worse. In no quantifiable way has he improved the Twitter experience. I mentioned ad revenue plummeting. I don't see a path to profitability. If they don't make it big on Super Bowl weekend, they're cooked.
He has slashed costs. And one qualifying question I would ask about that, is he going to make Twitter profitable before or after bankruptcy? In other words, can it be done, period?
Before bankruptcy would definitely be where I was leading with the poll.
All right, I think he can do it. He knows how to chop heads. He knows how to cut costs here. He's not even paying the rent. That's a big piece of the puzzle. And unfortunately, revenues for him are tanking as well, as you put. So I think he can do it. It's going to take a while. He's worked miracles on the floor with Tesla. I think he can do it here.
Tesla with zero ad budget has never had to have an advertising budget. He's never had to work with these companies. He's failing to do it thus far. We shall see.
We shall see. Coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. Welcome back. We are minutes away from the closing bell, so let's break down the market action. To begin the streak, to begin the week, we're beginning with a down note. No word if this is going to be a streak or not. The Nasdaq down 1%, the Russell 2000 down 1.5%. Taking a look at the sector action, only utilities and staples are in the green, so that is a defensive setup. And guess what? The mega cap sectors of XLC, that is communication services, which houses Alphabet and Meta, that is down 1.25%. Tech also down more than 1%. Followed by materials and real estate. Those are your underperformers. Now, taking a look inside the NASDAQ, we have Tesla. That is bucking the trend. That's up 2.5%. We see some staples names and some, looks like some healthcare names like Vertex, Honeywell, PepsiCo. Those are in the green. But for the most part, we're looking at a red tape. And here's our leaders. Now, we were just talking about Bed Bath & Beyond. Maybe we got time for that in a second. But meme stocks, that ETF is up 1%. Also seeing AMC up for no apparent reason here. Defense stocks, SPLV, that's low volatility and momentum. Those are the only styles in the green here. And to the downside, just about everything else. So let me get through to that meme board. And Bed Bath & Beyond, so small here, I can't even find it. Let's take a look at the sort here. We can see that stock is up 95%, Express up 15%, AMC up 12%. Are we going to see a repeat of the Reddit 2021 era? I don't think so, but interesting to track that. Now, the travel board, a little bit mixed here. Carnival, Royal, those are up 0.5%, 1%. Trip.com up 1%, Booking up 0.8%. Just about everything else in the red, especially the airlines looking like American and United down 50 basis points and 33. And just with 10 seconds left, it looks like, I'll put you on the bank stocks here. Also a mixed board, looks like Capital One, that's down 3%. JP Morgan up 0.6%. Here's your bell.
There, folks, is your closing bell on Wall Street for this Monday. Let's check out how the markets finished up. All down a little bit in the red, not too far. Dow down 36 points, S&P down 25, and the Nasdaq falling right even 1%. Keep in mind, 5 weeks into the new year, Nasdaq has finished on the upside. All 5, S&P 4 out of 5 looks like we'll start this week in opposite directions. Let's take a look now at some of the movers of the day, and we'll start with Dell shares today. You can see sliding 3% with the computer technology company joining this growing list of companies announcing layoffs. Since the start of the year, multiple reports indicating Dell plans to lay off 5%, just over 6,000 workers as a precautionary measure to stay ahead of downturn impacts. Now, Jared, it is interesting to note that we see that drop in share price here. We've seen stocks often rise after these announcements as Wall Street often digests layoffs to mean cost cutting and hopefully better profit margins down the road. Apparently, the big lesson that we're learning here is not cost cutting, but how severe PC sales have fallen.
I think so. And we take a look at our heat map on the Wi-Fi Interactive. We can see some of their competitors having a rough go of it today as well. We can see HPQ here at the bottom right next to Dell. That's down 2.5%. About Apple, not known for its PCs, of course, its namesake Apple Mac laptops. That's down 1.79%. I think the market for PCs in general, as advertised by some of these chip companies, just not there. This is not their time in the business cycle. Intel earnings a few weeks ago, they were a disaster. AMD had better earnings than them, but they're really attacking the server market. And you look at the pure PC plays, there's not many of them left anymore, Dave.
Yeah, Dell is 55% of their revenue comes from the PCs. And the data out shows PCs are down 28% in the quarter, but theirs were down 37, far more than their competitors. So a rough go for them. Want to take a look now at PayPal. Shares closing lower today after a bearish note from Raymond James. Analyst John Davis pointing to data from CyberWeek that shows PayPal branded checkouts lost market share to Apple Pay in the fourth quarter. This note coming ahead of PayPal's earnings release on Thursday, while other buy now, pay later business Affirm is set to report Wednesday. We heard last week from Apple that the tech leader is still seeing growth in the space with a record number of Apple Pay purchases during the holiday season, and that is bad news for anybody else, in particular PayPal.
Yes, and well, you just said the magic word, Apple. Let's take a look at our heat map for payments once again, and this is going to be on a market cap weighted basis, and guess who's that big square is, or rectangle to the left? That's Apple. So Apple, a competitor, you're going to see other competitors in that facing them flag a little bit, potentially just given their execution. But PayPal, you said they're up for earnings next week. Let's take a look at the one-year sorted performance of these various group members. And here you can see PYPL, there we go, right dead center in the middle, down about 35%. Now you'll notice Visa, MasterCard, these are very different entities. They are at a different stage in the business. Those are just about break even. Visa a little bit over, MasterCard a little bit under. But PayPal, you know, they're competing with Amazon, they're competing with Venmo, they're competing with, well, they were in partnership, or they were competing with Amazon in partnership with a firm. So I think this is a space that's probably suffering from margins, and what the Fed is doing is not helping the matter.
And we probably don't talk enough about how significant Apple Pay is for the story down the road, is obviously driving services, double-digit growth, and Apple Pay subscriptions. And I tell you, just as a father of 3 kids that have no idea what cash is, it's only going to accelerate in the generations to come because they literally have no time or patience for cash. It's all just a swipe of the phone, man.
To your detriment.
Yep, it's scary. They don't know what money is. And closing things out with the rideshare names, Lyft and Uber, both ending the day mixed, as you can see there. As Wall Street commentary trickles in out of each company's earnings release later this week, Gordon Haskett analyst Robert Hollins downgrading Lyft to hold while maintaining a buy rating on Uber. He points to a few reasons why Uber is the better buy here. First off, he has concerns about Lyft's app downloads and is projecting 19.5 million active riders in the quarter, about 1 million shy of estimates. Second, he says Uber has a more geographically diverse business model, therefore more shielded from legislation. And finally, while Lyft has been able to cut down wait times, it's charging about 10% more for rides than Uber. The most expensive ride probably won't be the favorite ride for consumers down the road. That comes as a huge surprise to me. I'm one who checks out both apps before every ride. Often find Lyft is cheaper than Uber.
It's funny you say that. I have both. I almost never go to Lyft. Uber is usually good enough to me. Every once in a while, when I get a really out-of-bounds Uber price, Lyft will kind of come to the rescue for me. But here's what I'm finding. Bloomberg Intelligence has a good analysis and preview of these two earnings that are coming up. So I just want to take about the Lyft tack first. Lyft's muted active rider and driver supply growth, and those are key because you need riders and drivers, may continue to weigh on top-line expectation. Active rider gains could moderate to single digits in the fourth quarter. And then we believe the company may see further negative revisions for the 2023 consensus, with its position likely getting weaker versus rival Uber in terms of driver supply and ride volume. So just not really competing in those key categories. Now, Uber is a sprawling company, not as sprawling and big as it used to be. It has other levers it can tap. So this is not an apples to oranges comparison, but in the pure mobility play, Uber is just really killing Lyft, and maybe it's because they're bigger and they can attack them on margins.
Yeah, in particular, Uber Eats, a huge differentiator for the two. And on the surface, you'd think they'd move together like cruise stocks. Anything but, really. When you look at Lyft is up more than 50% year to date. Uber still up more than 30%. But it only fell, it's down around 9% over the last 12 months, whereas Lyft really got hurt, down more than half their market cap over the last 12 months. They do not move like the cruise stocks. They certainly appear to be headed in different directions. Interesting to hear these analyst notes.
Yeah, and let's just go to the Wi-Fi Interactive one more time. I'm going to show you the heat map we have for mobility. And to underscore your last point there, Dave, Uber down 8.5% over the last year, Lyft down 54%, quite a bit more. And when you take a look at this chart, it has barely escaped the bottom end of this range here. Pretty nasty decline still in play. Has not crossed that Rubicon of that downward trend line. And you take a look at Uber, it's in very slightly better shape. It's not great shape, but it has a bigger base and it's gone beyond that negative trend line. So a little technicals there, doing a little bit better for Uber.
Man, I have theories. It's nice to have you bring the receipts, because if I was wrong, that would have been a really bad chart there. Thank you, brother.
You got it. Now, earnings season is far from over. Coming up, we're going to break down the latest numbers from Pinterest, Activision Blizzard, and Take-Two Interactive. Coming up.
Quarterly earnings, consumer confidence, and the State of the Union all coming up this week. Here is what you need to know.
Ready for this?
The week's big earnings report comes Wednesday from Disney, the first one since Bob Iger returned as CEO. Revenues are expected to be up about 7% year over year, with a slight decline in profits. The stock's on a roll, though, up 25% in January, easily beating the broader market. Disney's Black Panther and Avatar sequels, they dominated the quarter's movie box office performance. On TV, President Biden will speak to Congress and the nation for his second State of the Union address. Among the top issues expected in Biden's address, inflation, the economy, gun control, police reform, and the war in Ukraine. And the markets will be anxiously awaiting the delivery of the newest consumer confidence numbers. The University of Michigan numbers come out Friday. Latest reports show consumers are not feeling that great about the economy. The Fed's aggressive rate hikes hitting consumer spending hard, especially for big-ticket items like cars and houses.
All right, let's check out shares of Pinterest reporting fourth quarter earnings, and you can see shares plummeting down 10+% after hours. Yahoo Finance's Ali Canal here with the numbers, presumably not so good ones.
Yes, and this stock was down as much as 15% on the heels of this news. A big number that was a miss here was revenue. Revenue falling short of expectations, coming in at $877 million versus estimates of $887 million. Now, there was a beat on the bottom line, adjusted EPS slightly beating there, 29 cents a share versus the estimated 27 cents. Another metric to note, net income came in at $17 million for the fourth quarter after the company reported a loss of $65 million in Q3. If we move on to monthly active users, global MUAs increased 4% year over year to 450 million. That's on par with estimates. And then average revenue per user, a miss there, $1.96 versus the expected $1.98. Now, some headlines that are also crossing in this report. We have CFO Todd Morgenfield leaving the company. This comes amid a pretty big executive exodus that we've been seeing from a lot of these tech companies in recent weeks. Netflix is the number one that comes to mind, with co-CEO Reed Hastings stepping down. The company also announced a stock buyback program up to $500 million. But again, shares just reacting pretty poorly, down, as you said, 10%.
And Ali, just focusing on that key metric of ad revenue, basically those ad metrics that so many companies have been stumbling so far. What can you tell us about Pinterest?
Yeah, I mean, again, that miss on average revenue per user comes at a time where we've seen a lot of companies, specifically tech companies that rely on ads, missing on those fronts. We've seen struggles from companies like Snap, companies like Meta, Google as well. I think on the earnings call, investors are going to want to see a little bit more color, a little bit more clarity on the ad market, and also in terms of guidance. What are they expecting for the future? I also want to see more color on their cost-cutting plans and their organizational changes. We saw the company lay off about 150 workers last week. That translated to less than 5% of its workforce. So investors likely going to be looking for any updates on that front. So that's sort of what we're seeing right now. I'm just pulling up this press release here for guidance. They said, quote, "Our current expectation is that Q1 2023 revenue will grow low single digits on a year-over-year percentage basis, which takes into account slightly lower foreign exchange headwinds than Q4 2022. We expect our Q1 2023 non-GAAP operating expenses to decline to low double-digit percent quarter over quarter." So I think guidance is going to be a major focus on the call, along with the outlook for ads overall.
At least the U.S. dollar not taking as much of a toll in the fourth quarter. Thank you for that, Ali Canal. Now, joining us for a deeper dive into Pinterest is Tom Forte, D.A. Davidson Managing Director, Senior Research Analyst. Tom, always great to see you here. Your big picture takeaway from Pinterest earnings.
Yeah, so I was cautious going into the quarter on that layoff you announced for last week. So I've been monitoring kind of beats and layoffs. Big technology companies announcing layoffs and then reporting better than expected sales and profits. That wasn't the case with Pinterest. Both sales and profits were lower than expected. The other key takeaway here is that the digital advertising market remains challenging, both for the fiscal fourth quarter and the first quarter. That low single digit outlook, if memory serves, is lower than the initial consensus forecast and what we were looking for, which was more mid-single digit growth. So some challenging numbers from Pinterest.
And leading up, we've seen Meta, we've seen Snap, Tom. So taking that all into perspective, is this more of a Snap problem or just an ad environment problem?
I think it's an ad environment problem. If you were to do a compare and contrast Pinterest versus Snap, Snap was more heavily into financial services companies, often promoting cryptocurrencies. Pinterest, by way of comparison, was much less underweight in that type of advertisement. But when you think of the weakness in revenue for both Pinterest and for Snap, I think it's a reminder that the digital advertising market remains quite weak. The good news is, if you go back to the early stages of the pandemic, digital advertising was very weak, but rebounded very significantly when we saw signs that the economy is improving. So I think there is an opportunity for Pinterest over the next 12 months on an improving economy to see a rebound.
And Tom, one of the areas I just mentioned is the U.S. dollar currency headwinds, and you attacked this in your preview for Pinterest with a question: lesser than expected headwind from the strong U.S. dollar. The answer is yes. Could you go into detail about that a little bit? And then, what happens if we see a higher U.S. dollar this year? Can you kind of back out what's happened before and maybe apply that to the near future here?
So Apple's kind of the poster child for the negative impact on revenue from a strong U.S. dollar. Apple had nearly a 10 percentage point negative impact in its December quarter, and then it guided to a lesser impact for the March quarter. Pinterest, by way of comparison, had much less of a negative impact, but still a negative impact in the December quarter, and expects to have less of a negative impact in the March quarter. So the challenge is with the Fed raising rates and not some of the international monetary policy being as tight, you're seeing a very strong dollar, especially against the British pound and against the Japanese yen. And this is having a negative impact on the multinational sales and profits like Pinterest, like Apple, and Amazon, and others.
CFO Todd Morgenfield departing, part of the release. Any big reaction there?
Todd did a great job taking the company public. As is very often the case with these technology companies, you have a CFO comes in, takes the company public, hands off the reins to the next one. Perhaps this was a slower handing off the reins than we've seen in other companies. Todd did a great job, but this is a good opportunity. I expect them to find a very talented individual to replace Todd.
And Tom, we got time to talk about this share buyback program of up to $500 million. I guess I would ask, is this wise right now? Is this something that's going to excite investors potentially?
So while sales is under pressure for Pinterest, unlike a lot of other companies, they're generating very significant EBITDA and cash flow. They have a tremendous balance sheet. So for them to do a $500 million buyback is a reminder to investors that they generate very significant free cash flow, have positive EBITDA. Not true for many in tech right now. So I would say it's a good move.
Okay, Tom Forte, good stuff. Good to see you, my friend. Thank you. Activision Blizzard just announced its fourth quarter earnings. You can see shares up just mildly less than 1%. Yahoo Finance's Ali Garfinkel here with the numbers. It's been a tough sector, gaming recently. What are we seeing?
It has, but from Activision, we have a really key beat here. Q4 net bookings estimate came in at 3.08 billion, and the actual was 3.757 billion. Adjusted EPS was estimated at 1.52, and it came in above that. Monthly active users also came in above. Estimate was 388.4 million, and actual was 389 million. It's important to say, why did this happen? Where did the beats come from? The answer is pretty much Call of Duty, Modern Warfare 2. Expectations were solidly high coming into this, not only because of Call of Duty, but because there were a bunch of high-profile releases. There was a World of Warcraft, an Overwatch, and in this case, it's important to say the Call of Duty thing, yes, we can chuckle about it, but it was the highest-grossing entertainment launch of 2022. I believe in 10 days, it generated about $1 billion in sales. So they're still waiting on regulatory approval to be bought by Microsoft, but in this case, good news out of Activision today.
All right, well, we got to turn to also Take-Two Interactive. Those results are out. The numbers, please.
Yes, different story coming out of Take-Two. We have a couple of key misses and some meets. Q3 net bookings, they're coming in at Q3. 1.45 billion was the estimate, where the actual reality was 1.38 billion. Adjusted EPS estimate was 86 cents, came in at 86 cents, and they missed Q4 guidance. Analysts were hoping for 1.49 billion, and it was a miss. The actual was about 1.31 to 1.36 billion. They're coming off their acquisition of Zynga, the Farmville creator, last year, so they're trying to build their IP. It's kind of a building moment for Take-Two, and the results certainly show that.
All right, good stuff. Ali Garfinkel breaking Take-Two for us and Activision Blizzard. Hard day at work. Okay, coming up, you just heard Activision and Take-Two earnings. We'll break down the numbers and talk about what lies ahead for the gaming industry after the break.
Welcome back. Two of gaming's biggest names, Activision Blizzard and Take-Two Interactive. They dropped their latest earnings only moments ago after the bell. And for more, we're joined by CFRA Vice President of Equity Research, John Freeman. John, thank you for being here today. First, Activision Blizzard, nice beat on net bookings, $3.5 billion versus estimates of $3.1 billion, up 43%. Adjusted EPS, a nice beat. What's your takeaway, your big takeaways from the report?
Well, I was really surprised with Activision. I mean, clearly they're executing, despite the, potential distraction of the Microsoft acquisition. Call of Duty is just an outstanding property. And they, continue to. What's really impressive. They continue. It's over 20 years old, and they continue to find really compelling updates to it that, drive user engagement, which drives, obviously, which drives revenue. Obviously, video games, right? It's a little bit like landing an F-18 Hornet on an aircraft carrier at night in stormy seas. This is a very hit-driven business, but this is a pretty impressive beat on at least on the top line, no doubt.
That is a very colorful description, as always, sir. You mentioned the acquisition, which it feels like we've been talking about for years. It has been more than a year. And the New York Times now reporting that Microsoft expects the UK to be an even bigger problem and oppose that. What chance do you give this of actually coming to fruition?
So it's kind of interesting. If I didn't know what the stock price was, I would say, it's, they're going to have to make some concessions, but then it might be a little rough, but they should be able to pull it off. Yet at the same time, the stock, I've never seen a differential. The offer price was $95 a share. The stock is trading at $72. There's obviously a lot of smart money, a lot of investors betting that it's not, the wisdom of crowds, right? I mean, if you go by that, then it says that, it looks like it's going to get blocked. And obviously the UK, personally, I also cover Microsoft. I don't think this is the right acquisition for them. I understand why they're buying it. It's all about Call of Duty, no doubt. And the proto metaverse sort of, that's what they want to sort of get their hands on. I understand that. But I think that from a regulatory perspective, it really just adds, additional scrutiny to Microsoft, which obviously as a big tech member is already got, a fair amount of scrutiny. So, I wouldn't mind them giving up on the acquisition, but, obviously they made the commitment to do it. It seems like it's really the regulatory resistance is pretty heavy.
And John, let's switch gears to Take-Two. Your forecast was a little bit light, seeing net bookings of $5.2 billion to $5.25. Estimate was for higher, almost $5.5 billion. What are you seeing in this report? Anything that stands out to you?
What stands out to me right now is, and it's the thing I've been concerned of. I think the valuation for Take-Two, if you're a long-term patient investor and you can ride the ups and downs of the hit-driven video game industry, then I think shares are really attractive. But I am worried about the Zynga acquisition and the integration issues. This was not a merger of equals, but it's a merger. It's a pretty significant organizational merger. Whenever you have that, you're going to have the risk of integration issues and business disruption. And maybe we're seeing that in the results here for Take-Two this quarter.
So, with the exception of Call of Duty and maybe a handful of other titles, how would you describe the gaming sector as we are beginning 23?
So, obviously the glow of the heightened engagement that we saw post-COVID, that glow has faded. And now, now you're seeing the real more generally hit-driven aspects of it. And, some are hits and some are not. So that, that's the dynamic that I think is going on. But I also, longer term, I really do have a lot of confidence in the more immersive type games. The sort of what I call proto-metaverse kind of games like Call of Duty, like GTA as well. And we're seeing GTA 6, it's coming down the pike soon. I'll be very interested to see what commentary Take-Two has on that on their earnings call.
I have to admit, I'm not a gamer, but I used to work at a video game store, Electronics Boutique, back in the mid-90s. That's how old I am. I'm just wondering, how levered are these companies to the console cycle as they have been historically?
So they are less levered now. But this last console cycle did have an impact. I mean, obviously it was hitting with the wave, released in 2020, obviously hitting, concurrent with the COVID, lockdown sort of surge in engagement. Take-Two, both Take-Two and Activision are very leveraged to it. I think Take-Two is more so. But I think the console, is still relevant, and it does bring that sort of those types of really immersive games, the ones where that the real hardcore gamers really get into. I think that's still very real. You don't get that kind of immersive experience from a mobile game. You just don't yet. That's not in the cards for right now.
As you mentioned earlier, you do cover Microsoft. The news today that Google says they're going to unveil Bard in the coming weeks. How significant is the Microsoft advantage, and how big a threat is it to search?
Well, I think it's a threat to search, because obviously if Microsoft can use ChatGPT to take any sort of share, that's all upside for them. But really, where I see Microsoft, where ChatGPT, I think, plays an even bigger role potentially, is with integration with Office. Kind of think about it as autocomplete, but for entire paragraphs and pages rather than just single words, right? That's a potentially tremendous productivity helper. So, Microsoft will find a way to monetize that, over time. So I think that's really the integration with Microsoft Office, I think, is actually a bigger deal, at least in the short to midterm.
Well, hopefully we don't see that integration among ChatGPT and Call of Duty or any of these other games. I don't even want to go there. Thank you for great insights. John Freeman, we'll speak to you soon. Coming up, a showdown at Disney World as union members overwhelmingly strike down Disney's latest contract offer. One union negotiator tells us what Disney must do to get a deal done. Up next.
Not so happy at the happiest place on earth. Thousands of Disney union members voting down a new contract that would hike pay by $1 an hour each year for more than 30,000 Walt Disney World service members. 96% of members rejected the proposal, saying the $1 yearly increase does not go far enough to cover the high cost of living in Central Florida. Joining us now is Paul Cox, a Disney cast member and president of the Orlando Stagehands Union, IXIC Local 631. Yahoo Finance's Ali Canal here with us as well. Nice to see you both. Paul, we'll start with you. You help lead the negotiations for this new Disney contract. Disney already pays $4 per hour, more than Florida's minimum wage, and that offer takes workers to at least $20 an hour by 2026. Why are you a no here?
So the realities are that the inflationary pressures that the cast members have faced in the last year far outstrip what a dollar equates to. $16 an hour for a cast member who's making $15 today is 6.67% increase, right? And as your viewers know, that's not the rate of inflation. So that's just not keeping up with the realities that the cast members are facing. The other part of it is that Disney is known for world-class service, not the minimum. They're seen as the maximum, the gold standard of customer service. So to try to equate the minimum wage to that gold standard, that high level of guest interaction, is not a fair comparison, right? These are workers that are equal to any other high-end service industry worker that is selling a luxury good, in essence.
And Paul, we reached out to Disney for their response on this vote. A spokesperson saying, quote, "Our strong offer provides more than 30,000 cast members a nearly 10% on average raise immediately, as well as retroactive increased pay in their paychecks. And we are disappointed that those increases are now delayed." Disney is offering other incentives as well, like 8 weeks of paid family leave, a 401k option. What comes next here? And are you prepared if Disney doesn't budge on that minimum wage number?
Well, so I got to point out that in their quote, they're quoting a 401k. That 401k is unmatched. It has unrestricted fees that have no check or balance from the union or anybody else. So it could very quickly become a profit center for the company, for an investment opportunity for the cast, one. Two, for a cast member who's on the edge of poverty, how are they going to take money aside to put away for savings, right? That's the first ludicrous statement in that. The second thing is that a nearly 10% increase, somebody's rounding up pretty significantly, right? I can use a basic calculator. $16 from $15 is, again, 6.67%. So that's not exactly a fair standard. That's my first thought on this, right? We have to do better than the minimum. This is a world-class company with a world-class product.
So what do you need then to get a deal done? And again, what if Disney doesn't budge on that? What is a strike potentially on the table?
Well, right now we're looking forward to getting back to the table with them, right? A strike is always an option in a labor dispute, but I don't think that we're anywhere close to that, right? The realities is that the company said this was their best offer. We asked the workers to voice their opinion. This is where we are. So there's a ways to go before that happens. It's not a tomorrow thing. It's not a next week thing. But I'm not going to take any options off the table as we go forward, right? So what we're looking forward is increases that respect the inflationary pressures that the cast members have faced.
Paul, you know this is a public company. Any fear that your demands, $3 an hour raise, will eventually end in people losing their jobs? You know the pressure they're under from shareholders.
So the Walt Disney Company, the vast majority of its income comes from the site that I worked at as a cast member, right? This company reports publicly, as a publicly traded company, that it makes billions and billions of dollars in profit every quarter. And they beat those profit numbers most quarters, quarter over quarter. So while other portions of the company are facing pressures, Disney Plus being one of them right now, the business unit that these cast members work in is making more profit every quarter. And just like in any other corporation that's doing well, these workers want to share in the gain. So no, I don't think that the answer here is that the cast members are going to get a raise and then they're going to get laid off. That's not how that works. Also, these are the same cast members that produce that economic engine that fuels the Disney company forward.
And Paul, we've seen an uptick in corporate unionization efforts from Starbucks to Amazon. Why do you think this is happening now? And how does this movement help your own fight at Disney?
So, yeah, unions are more popular than hot dogs in America right now. That is an absolutely wonderful fact. But it's because when companies don't take care of the workers have their own process that they can go through and have collective voice. It is, in fact, supply and demand economics, right? The workers are a part of the supply chain. And if they're not respected, just like any other supply, the price can go up. And unions help provide that ability to negotiate on equal footing with corporations. So corporations that don't treat their employees correctly absolutely will get unionized, right? In my industry, we have a lot of good employers, but because most employers are most employment situations are multi-employer, that's how insurance and everything else happens. So I can totally understand the increase of unions, right? I've worked in unionized work my entire career. And it has, ever since I've worked in a unionized environment, my life has become better.
And Paul, finally, coming up on Wednesday, we have Disney's first earnings report since Bob Iger reclaimed his CEO title. From your perspective as a cast member, what are your thoughts on Iger's leadership so far? And what would you like to see from him as he resets this company?
So I'm expecting the second verse is the same as the first, right? I don't think that Bob Iger is personally a white shining knight that's going to save cast members. I'm hoping that he'll do some things that make more sense and puts things in better perspective for employees. But I don't think that is a magical pill, Bob Iger taking back over the company as the CEO. I think there's a lot more pressures involved in there, but we'll see what happens.
All right, keep us posted. Allie Canal, thanks so much. Paul Cox, thank you as well. Coming up, more companies want their workers back in the office, but what happens if you want to keep working from home? We'll break down your options next. 50% of workers are back in the office. That's according to the latest data from Tracker Castle Systems. The data measures weekly average office occupancy rates from the top 10 cities, with half of workers back in the office. Will the other half soon follow? Joining us now is Yahoo Finance contributor Mandy Woodruff-Santos. Mandy, nice to see you. Not everyone wants to go back to the office. Who's still home, and what cases are workers making to stay remote?
Yeah, like you mentioned, the majority of workers are actually back to office. But I think the reason we haven't seen widespread rioting about this is because the majority of workers are actually on a hybrid work schedule, which I think suits everyone. And I think we're going to see many more companies make a transition into the hybrid work schedule. For those who are 100% remote, the lucky few of us still left, I believe these are people who got exemptions permanently to work from home. Maybe they moved states during the pandemic, or they may have a physical or mental health, reason for being required to work from home, or they just may have a flexible management team who's giving people really the option to choose whether to come into the office or stay home.
Indeed, very envious of your remote status, my friend. If your job is asking you to come back, what can you do to fight for your case?
Well, the first thing is, they can legally force you to come back into the office. That's just the beauty of employment law in this country. But however, if you're someone whose lifestyle has changed, if you have moved, or if you have other concerns, for example, I've got a good friend who works at Disney who just gave birth to a new baby boy and is not interested in traveling 2 hours each way from her new home in Connecticut. So like her, I would suggest, really state your case, go one-to-one with your manager. What I'm finding is that even though companies have company-wide policies for hybrid or remote working or return to office, managers and different department heads are really approaching these case by case. So you may be able to make a personal appeal to your manager for an exemption. Now, I would get everything in writing because management can change. Anything can happen. Your manager may leave, and you want to have documentation that you were granted this exception. All right. Also bring any, if you have a doctor's note, for example, if you have a note from your mental health provider, or a note about any, for example, people who are still immunocompromised still may not feel comfortable going back. I'm immunocompromised as a mom to be again, and I'm not excited to get on the subway in New York City because even though the pandemic is, on its way out, it's still very much there along with other viruses, right? So bring your documentation, go to your manager. Ultimately, though, stay flexible.
Yeah, there's nothing like getting on that packed subway car and people are coughing. So we brought up that number, 50% are back in the office, according to Castle. Do you think that will keep rising, or have we reached some sort of equilibrium? Are we going to see flattening out ahead?
I think through the end of 2023, I think we're going to continue to see that rise and then probably see some flattening out in 2024. I think you've seen a lot of big companies announce return to work policies, and smaller companies are now going to be following suit, sort of putting some changes in place. If you're concerned about it, I would avoid making any huge life changes right now. If you can avoid moving states, if it could potentially jeopardize your job, talk to your manager and make sure that there's transparency and clarity. Are you guys planning or discussing any possibility in changing my remote work status? Because, I've got to make some life choices here. But if you are someone who is continuing to work remote, I would get that reiterated again in writing by your manager that it's allowed and for how long you're able to be allowed to work from home. It's all about that paper trail, right?
Yeah, many promises are made, Mandy. Get it in writing. Anecdotally, Friday seems like nobody goes to work, but I go to the train station, there's no cars there. Is that nationally become the fully remote day?
Absolutely. I'm with you. I dropped my husband off on Friday so he can go to work. Unfortunately, he's got to be in 5 days a week, and it feels like he's the only one. It's a ghost town. Yes, and I think also what we're seeing is a choice. Companies saying you can be in the office 3 days a week. We're not going to dictate which days. And I think it's natural. People want a little bit of a relaxing Friday, which I don't think anyone should begrudge them. I mean, to be fair, remote work has no impact on worker productivity by and large, research has shown. So I think companies should stay as flexible as possible with their workers. I would caution workers or just encourage them, though, even if you are required to return to office a few days. Go into the office, even if you do remote work, at least once a quarter to have some face time, connect with colleagues. You may even, dare I say, enjoy it, because socialization is just a part of our, human nature, especially when we're at work. So I don't think it's all bad news for workers, as long as companies continue to be as flexible as they have shown to be so far.
Very excellent points from Mandy Woodruff Santos. Thanks so much. Appreciate that. All right, coming up, it may soon cost you more to see a movie at an AMC theater. We'll tell you why and specifically where next.
Let's take a look at what's moving after hours. We got Chegg, PetMed, and also Simon Property Group. And let's take a look at Chegg. The education company down about 20%. You can see 20.16% after guiding its full year revenue quite a bit under expectations. 745 to 760 million versus estimates of 820.5 million. Also seeing gross margin a bit light of 71 to 73% versus estimates of higher 74.8%. Also seeing lower EBITDA as well, 240 to 250 million versus a higher estimate of 275.6 million. And you can see the results here, Chegg down 20%. Now, we're also looking at PetMed, and let's take a look at that right there. You can see that stock is down 5%. They just reported an EPS of $0, and that is lower than the street estimate of 20 cents. Sales also coming in at $58.9 million, and that is down 3% year over year, which the CEO and president, Matt Hellett, commented on. He's saying, quote, revenue was down year over year 3%, but stable sequentially, despite the prior quarter benefiting from an elongated flea and tick season. So at least somebody is benefiting from that. Also taking the pulse of the home builder sector, we have Simon Property Group reporting funds from operation per share at $3.40 for the fourth quarter versus estimates of $3.14. And for the whole year, they see that coming in at $11.70 to $11.95. That is lower than the street estimate of $12.12. Occupancy, another key stat, that was 94.9%. And lease income, that came in at $1.29 billion versus $1.26 billion expected. Let's just take a look at Simon Property real quick. This is a 5-day chart. I want to take a 2-year chart so we can see the trek through that peak late November, I believe, of 2021. Just bouncing back right now. Decent bounce from that September, October low right there, Dave.
All right, Jared, thank you, sir. Going to the movies might get a little more expensive. AMC is rolling out a new initiative where the price of a ticket will be based on seat location. Customers will have the option to pay more or less admission based on where they sit in the venue. Obviously, seats in the front will be at the lowest price level. So the question is, Jared, where do you sit in the movie theater, and what do you think of this new policy?
I think people are going to hate it, and it's probably going to happen. Look what happened with the airlines all those years ago. They started charging for luggage and food and all these extras, and now we kind of take it as normal. I think, why not AMC? I usually sit somewhere in the middle. I've tried the front. It's a little bit too close, not for my taste, but would I pay a little bit more? Probably not, because I'm not paying anything for movie seats right now. That's just me.
I happen to agree with you. Now, I think this is an obvious choice for them. We pay more at whether it's games or concerts, no matter what form of entertainment you go to, it's based on your view of that entertainment. So this seems obvious, but it seems like something they would have done, and you're wondering about those shares. They were halted on volatility. It's been a wild meme trading day for all of them. But getting back to the original point here, it seems like something they should have done 10 or 15 years ago. Doing it now, I question the timing. It's hard to get people back to theaters. There's not many quality hit movies coming out. So to be charging people more right now is a really dangerous move. Now, to charge people less to sit in the front, I think that is a no-brainer. I'm with you. I don't think anyone's going to pay more right now to go to a movie and sit right there in the middle. We haven't seen the pricing tiers, so maybe they're just bringing down the lowest level and not bringing up the middle. That would be my advice.
Why not?
If they're listening.
I mean, if they were discounting some of the seats, maybe they just make that up in the concessions anyway. We all know those $10 sodas, pops, whatever you like to call them, those can get pricey as well. But I'm thinking back to all those capital raises that AMC successfully did when they were a meme stock. I guess they still are, but the meme price of that stock was higher. So at least they're in a better capital position, having capitalized on that a couple years ago. But yeah, a lot of these brick and mortar places, they're struggling under an old regime, trying to figure out what to do in the new one. And I don't know, charging different prices for seats, probably.
You got to give AMC credit, though. They're often creative. They've been thinking of, they've been throwing all sorts of stuff up against the wall over the last 2 years to see if they can turn them around.
The CEO is very investor friendly as well.
He is an interesting cat.
An interesting cat.
Very fun to follow. We'll see how this works out. That'll do it for Yahoo Finance Live today. Be sure to come back tomorrow, 3 o'clock Eastern Time, for all your coverage leading up to and after the closing bell. We'll see you Tuesday.